Good day, fellow investors. We are a value investing channel, and therefore value investing is about focusing and avoiding the risks out there. And I made a video recently discussing how the S&P 500, the prices, the trend, is not in line with fundamentals. And then there were many comments, many great comments, how whether we should rush into tangible assets, whether should one sell, keep dollar cost averaging, and other comments, should I just sell and sit on cash, what to do, because it's most likely that the market might drop in the future. And there were also other comments how I'm just here to scare you so that you buy a subscription to my research platform. Well, you see what best fits you, but I think that the answer into what's going on and what's the strategy next, what to do with portfolio, is in the investment philosophy one might have. And investment philosophy, investment strategy is what I want to discuss now. What drives your investment returns? If you understand what drives your investment returns, then everything, no matter the environment ahead, is much easier. The driver of investment returns. And therefore, you have to think about your investment strategy. And here we have, speaking again of the S&P 500, a great call on why stocks are still a good buy. Higher value of earnings, higher cash flows related to earnings, less investments, better return on invested capital, better businesses, and therefore deserving a higher P/E ratio than the historical average. Lower interest rates projections, if interest rates go down, asset values go up. That's logical. US global leadership, technology, military, higher government debt levels, that printing money puts more money into the financial system, thus higher valuation. Of course, returns might be somewhat lower, but still 6-7% over the long term because of the tech and competitive environment. Nothing wrong with that. However, if interest rates go higher, as was discussed in this Jamie Dimon video 2 days ago, then you know that it can get ugly. And you have to see whether you want to be a stocks only go up investor or something else. And it's very hard to think in a different way because, yes, stocks only go up. The S&P 500 is up 40-something times, 50 times over the last 45 years. And then when you see this 50x, you think, Sven, what you're talking about? However, if I look at the recently published Global Investment Yearbook from Professors Dimson, Marsh, and Stoughton, very well done by them each year, you see here that the annualized risk returns over the very long term for US stocks, 6.5, add 3% of inflation as these are real returns, and you get to your 10% from stocks. Okay, nothing wrong with that, but just check this. The current P ratio of the S&P is 28. Historically, has been around half of that, 15. And if I translate that to earnings, the current earnings yield is 3.57. Average has been double. So that will lead to half of the returns in the future just on that earnings yield and valuation. So you're already buying at twice the price than historical averages. And yes, the comment was correct. If it was 10% in the past, it will likely be around 6%, including inflation in the future. And you have to see how that 6% fits you. Now, this 6% doesn't mean that stocks will go up every year 6%. It might also mean that stocks will do nothing for 20 years and then go up 50% in a year or something, and then you get your returns. So it could be volatile, it can also crash 50% and then come back over time. That's something you have to accept. Plus, if you look at the determinants, at the drivers of investment returns, the current dividend yield is 1.37%, a third or a quarter of historical yields. Okay? And if that is a quarter of historical yields, if you expect your money to come from dividends, then again, it's not that much. And yes, also US stocks have done really well, but world, ex-US, we are already 2 percentage points lower. And the lower you go, long-term compounding is less. And then again, watch this. When the US market was at the peak globally, we had ugly times afterwards. US great in the 1960s, the famous Nifty 50s, very bad times for the next 15 years, dot-com bubble, 12 years of bad times, and we are now again here peaking. And now, when it comes to investing, let me ask you a question. What is investing for you? Let's say that you have a 5 million portfolio in the S&P 500. Do you focus on the 5 million or you focus on the dividend yield of 68,500 per year? What is more important for you, the 5 million or the 68,000? Because if you focus on the 5 million, then you're running the risks of interest rates going higher, etc., etc. And that can be 3 million next year, can be 7 million. But you are then focusing on the price, on the number of your portfolio. If you focus on the dividend yield, then you're focusing on the value creation from that portfolio. And that is the difference between value investing, real investing, and what I called speculating in the market. And what's my truth, my belief is that I can build a value portfolio that I can add chip by chip over time and compound in that way so that whatever happens with the market, I don't care. And just discussing those questions, if you are a dollar cost averaging investor, then you just keep dollar cost averaging. You hope that the market crashes because then you can buy twice what you are buying now here, and you just ride those cycles over 20, 30 years. And then with more volatility, with more crashes, you will reach that 9% return over time, 7, 8, and you can be very happy. If there are no crashes, you will get your 6%, 5, 6%, and still you will do much better than just holding a long-term bond. Nothing wrong with that, but the key is that when those crashes happen, you buy more and you happily buy more. Another strategy, should just one sell assets? My idea is that you just find what fits you best. If you want to buy a house, if you need 200K in 2 years, then just plant them into short-term treasuries, get the yield, and that's it. If you are not happy with this, you might just put the 5 million into a treasury, long-term treasury, and get 225,000 per year. Of course, over the long term, you might lose some on inflation, but you can reinvest just this money to compound. You can do whatever you want, just find what best fits you. Of course, the principal will be worth much less because of inflation. So my belief is that with focus, with work, one can have both. Have both compounding income, dividends, reinvested earnings, even buybacks, and have both businesses that offer growth. And I am biased or whatever because it worked for me since 2012. I did much better than the S&P 500, so you can call it my truth or my bias, whatever. I don't care what the markets do. I just invest my money to compound my chips over the long term, and that's about it. And yes, if you want help in doing that, you buy the subscription to my research platform. But even if you don't want to buy, but you are interested, we discussed ADM, that's a good business. You can check China stocks yourself. I'm constantly giving you ideas to learn more about how that can be done over time. Verizon with the dividend yield, interactive brokers, etc., etc. This is what I do, risk and reward, and then trying to structure that into a value-based compounding machine. If you want to check more, check my research platform. I'll see you in the next video.